All right, you guys, welcome to our YIS Global Online Club meeting. It's great to see all of your faces today. Today, we're going to be going over the value of a stock, lesson 2, what is the value of a business? Today, we have some exciting things for you. We have YIS founder James Fletcher, who will lead a discussion on the stock market outlook during COVID. And he'll be doing a Q&A session afterwards. So that'll happen at the end of our lesson today. So let's get started. We have Saurabh Khanna, who is our Young Investor Society Student Advisory Board member secretary, who's going to be your instructor today. So Saurabh, without further ado, I will hand it over to you.
Yeah, so I think the first thing we should do is discuss an idea of the week. So I had two ideas that I want to go over. So the one is the antitrust lawsuit against Google. So the Justice Department under the Trump Justice Department under William Barr filed an antitrust lawsuit against Google, alleging that they were, I think, being unfair to consumers. So I guess I can have my take. I mean, I'm not a lawyer. I can't predict where this lawsuit is going to go, but I think at least this lawsuit will at least shows I guess, bipartisan nature of aggressiveness towards big tech. And I think this is probably a precedent and at least a warning of what is to come, maybe on the legislative side as well. So I think we may have some possible antitrust legislation that may be in the pipeline. I guess I'll open the floor to anyone who wants to give their thoughts, and then we can go into the lesson. So does anyone have any thoughts on the Google antitrust lawsuit? Or okay, well, that's fine. I guess we'll go into the lesson right now. So Christine, I'll share my screen. So okay, so do you all see this?
Yes.
Okay, perfect. So so before I actually start, let me give some background on myself. As Christine said, I'm Saurabh. I've been in YIS for about 3 years, since my sophomore year. And I went to the YIS stock pitch competition twice, and I ended up getting an honorable mention or 4th place in the global stock pitch competition in just this year in my junior year. So let's get into this. So we're doing Unit 2, the value of a stock, and that we're questioning, and we're talking about what is the value of a business and what are the different factors that you use towards valuing a company. So, all right. So let me read over the overview right now. So this lesson will introduce you to initial public offerings, or IPOs, market capitalization, and economic moats. And we're going to analyze the value of Apple and learn the 2 most important factors in determining the value of a firm. Let's read the objectives as well. So we have 4 objectives that we're going to accomplish. So one is understanding the role of IPOs in determining stock prices, calculating market cap in addition to actually finding out what market cap is, understanding the key factors that determine the value of a company, and applying this kind of knowledge to our investing lives and our investment framework. All right, so let's get into this. So first, let's start off with the 3 main things that we want to go over. So IPOs, market cap, and economic moats. So let's look at IPOs first. So an IPO, in essence, is effectively something that it's effectively when a company initially puts their shares onto the public market. That's why it's called a public offering, initial public offering. That means it's the first time that a company makes their stock public. So, for example, if you watch the closing bell every weekday at 4:00 p.m., you'll either see on the New York Stock Exchange or the Nasdaq, you'll see the people who actually close it are typically those who a firm that went public that day. So that can be on the New York Stock Exchange or the Nasdaq. So, for example, way an IPO would work would be that if I had a firm and I wanted to make my firm public, I would go to, say, an investment bank, and they would do the proper legal procedures, and they would also attract prospective investors, and they would do all the relevant processes in order to sell my shares onto the public market. So I hope that uh, that explained. I hope I explained the IPOs really well. Does anyone have any questions on IPOs before we move on? Feel free to unmute on. Okay, so we'll keep going. So, okay, so I guess IPOs can be sliced and diced multiple ways, and one way you can do it is through adjusting how many shares you want to buy and sell. How many shares you want to sell to the market. So, for example, this is an example on the Prezi. $100 million of equity that someone wants to sell to a public market can be done many, many different ways. These are just two examples that were given. One example is 20 million shares at $5 a piece. Another one is 10 million shares at $10 a piece. So I guess these are the different ways that these are different ways that IPOs can be structured and how IPOs can be executed. All right, so here's a question that we can pose to the audience. So what do you think are the advantages or disadvantages of selling more or fewer shares? So for example, in this scenario, so what do you think is the advantage of selling, say, 20 million shares instead of 10 million shares? Does anyone want to answer a question? Answer the possible advantages or disadvantages? So someone said small investors. So do you want to elaborate on that? Sure, feel free to unmute.
I was thinking about puts and calls, especially where if you do a put, you're obligated to buy 100 shares of the company. And so I was thinking if you do that with a small stock, such as Zynga, it's a lot easier for smaller investors, such as us, to do that.
It's also easier for them just to buy it in general, right? If I had, say, $500, buying a stock that's worth $1 is far easier since I can manage risk easily. It'd be easier to structure that in my portfolio, since instead of if I buy like a $500 stock and I have $500, that's going to be one share, and my entire portfolio will be resting on that one stock, right? So I think you make a good point there that more shares with a smaller price gives you a lot more flexibility for investors. Does anyone else have anything to add?
Disadvantage could be that there's going to be more volatility in the stock, which could easily cause it to go down just on emotion and sentiment.
It could. What makes you think that it would have lower volatility?
If it's a lower price stock, then there's going to be a lot more day traders involved in it, and then they could easily drive the price down. So that's a big, that could be a big problem.
So do you think that? So I'm just trying to play devil's advocate. Do you think that day traders make like a large amount of the liquidity that's involved in the market? Do you think it'll be a high amount of do you think it'll be only subtle, or do you think it'll have a massive effect on?
I mean, usually it'll just be subtle, but there could be days where they could all drive it down if there's a big trend, then they could all jump on it.
Yeah, that's a good point. So does anyone else want to add, or? All right, so let's move on. Whoops. All right, so that we just finished with IPOs. So let's move on to market capitalization, also called market cap. So market cap is basically one of the most quoted things that you'll hear when it comes to a stock. So if I look up Google or Apple or any stock right now, one of the first things you'll see will be market cap. So what is market cap? Market cap is effectively the shares outstanding, in other words, the shares that are on the public market, multiplied by the price per share. So multiplied by the stock price. So for example, if I had 500 shares outstanding that I sold to the public, and I had a $5 stock value, so that would be $2,500 in total. 500 times 5 would be 2,500. So that would be the market cap of my firm, of my imaginary firm, if I made it public. So it's actually a quite simple concept. Does anyone have any questions when it comes to market cap? Or, oh yeah, sorry, I actually forgot one last thing. So market cap is so important in order to measure size, because so there are about four classifications So when I say firm, Gabriel, is basically business. Firm, business, company, they're effectively the same thing. So there are 4 classifications when it comes to market cap. There's large cap, that's the big hitters, the Amazons, the Walmarts. There's mid cap, which is still robust firms, but they're just not as I guess they're not worth as much as the larger, more household names. There's the small cap, which are the more unknown firms. There's the micro cap, which is the lowest of the low in terms of market cap. So does anyone else have any more questions when it comes to market cap? All right, so let's move on. Okay, so here's an exercise. I think it should be really simple. Calculate the market cap with the stock price of $5 and 10 million shares. If you want to go into the chat or you want to speak up, you can do either one. Okay, so yes, 10 million outstanding shares. So, and perfect. So perfect, Gabriel. So $50 million in market cap. Really simple math. 5 times 10 million, that's 50 million. So, all right. So, and now that's a very simple exercise. Let's move on to, this is another exercise that we're doing. Comparing 2 companies. Company A, whose stock price is $10 a piece, 1 million shares, and company B, whose stock price is worth $5 with 10 million shares in total. So calculate so by worth more, we mean by market caps. In other words, calculate the total market cap of both companies and which one of those companies is worth more. You can put it in the chat as well. So yeah, so it is company. Okay, so yeah, so it is company B. You're right that so since company B's cap is worth 50 million, A's is worth 10 million, it's quite obvious which one's higher. All right, so let me get a drink first. So economic moats are the third concept we're gonna go over. Arguably, in my view, economic moats are the most important factor to consider when it comes to evaluating a company. So, so let's think of what exactly is an economic moat. So if you think of what a moat is, it's a barrier. It's a robust barrier that surrounds a fortress or a castle that outsiders or competitors or rivals cannot cross and I guess compromise the fortress, right? So economic moats work the exact same way. They're a quality that a company has that makes it extremely difficult for for competitors to empower them. So there are many different types of economic moats. One is Coca-Cola, and it's having a strong, and Coca-Cola is an example, and it shows that having a strong brand can be an example of a moat. So Coca-Cola's brand is obviously worldwide, and that gives it leverage over its competitors. For example, if I started a soda company with the exact same formula as Coca-Cola, Coke would outlast me, since their brand basically permeates our culture and is known throughout the world. So that obviously is going to add to its sales and its edge over its competitors. Another one is lower production costs. When you have lower production costs, you have lower prices. So that obviously is an edge. It can be using a different material which can produce lower, and that allows for lower costs. It can be economies of scale. It can be moving your manufacturing to a place that's cheaper. All these things can give you a lower production cost and by extension an edge in price. So okay, so here's another, which is network effects, and these are particularly for industries in which the value of your product depends on the amount of people using it. So this works particularly well for Facebook because as a social media platform, the value of the platform depends on the amount of people using it, since obviously people want other people to be social with on a social media platform. So Facebook's business model has allowed garner large amounts of people, which increases the network effects and allows it to dominate its competitors in the social media space. Okay, so I know it went through a lot. Does anyone have any questions as of now as to this lesson, or should I move on? Oh, all right, so I'll move on. So two critical questions. We're going to go over two critical questions to answer when determining what the value and worth of a company is. So both of these have to do with profit. So let's take a look at those. So the first one is going to be, how fast are the profits going to grow? So you want a solid and robust growth rate that is obviously going to deliver good fortune for the company in the future. So as of with this graph, obviously you're going to be investing in, at least I would invest in the company that represents that green is represented by. So because it obviously has a very good growth rate that would deliver very good returns on my investment. So that's how fast are they going to grow. So do you want them to grow? You want it to have a solid growth rate. However, you actually want, as an investor, you're thinking in the long term. So you also want these profits to be reliable, and you want them to be sustainable for you in the long term, so that you would consistently have a good return on investment. So in this scenario, the blue stock is obviously going to be far better because its growth rate is far more reliable. The green one obviously had a very good run, but its run shortly ended, and its profits obviously collapsed later. And the blue one will obviously be a better bet for investors. Let me check the chat. So which point are you getting? So with misinformation, so Maura, do you want to elaborate? So which area are you do you get stumped at?
Oh, it was previously when we were talking about economic moats.
I see that. Okay, so did I answer your question in my presentation when it comes to which specific things are like brand names in terms of?
Yeah, sort of.
Yeah, okay. So economic moats can actually like differ by industry. So like for certain ones, it's the brand name, like Coca-Cola. But for example, my stock pitch competition was it was a healthcare stock, and it had a patent on a very special heart pump and we saw that heart pump being in greater demand. So its edge was its product and the legal protection it had on that product. So I wouldn't say that there's like a so-called good economic moat. I guess it has to depend on the industry. A book that I would recommend that really taught me about economic moats was this book called I believe it is The 5 Rules for Successful Stock Investing. It's by Pat Dorsey, who's the head of stock research, who's the head of research at Morningstar. So that actually has a specific industry by industry run through in terms of how this industry works, how to find good economic moats, and how to find good firms. I hope that helped. Do you have any other?
No, I'm all right, and thank you. That does clear some things up.
Yeah, thanks.
So Rob, can I chime in with my thoughts on her question? I think it's a great question.
Sure.
So hi everyone, this is James. I know I'm speaking at the end, but I'll butt in here and give my thoughts. I agree with Saurabh. I think economic moats are probably the most important thing as an investor, to analyze the competitive advantage of the company, to get it right, and to identify how sustainable it is. I think Saurabh nailed it, that all of the economic moats or competitive advantages can be powerful. And so I wouldn't necessarily, so sometimes investors will say, the competitive advantage is a low cost, that's just not as attractive as a network effect type internet business. And so they're just not as attracted to maybe a low cost moat or even a brand moat than a network effect. What I would tell you is I've personally had successful investment track records in in all of the different moats. As long as the advantage is real, the profits and the cash flows are sustainable, all of the moats can be successful. That being said, and I'll give you guys a thought. I presented at Warren Buffett's Berkshire Hathaway conference a year and a half ago, and at one of the value investor conferences. And what I gave a presentation on was the network effect and how powerful that network effect is. And at Berkshire Hathaway, you get a lot of sort of old school value investors that are looking at price to book as the only core metric of value, and they're looking at really cheap stocks. And I went in and I pitched, 2 Chinese internet companies. And so I felt a little sheepish going into that room pitching those companies. But my argument was network effect businesses become so powerful because once you become Google, you become so dominant that the flywheel begins to spin and your market share becomes very easy to forecast. Once you hit the tipping point of like 60% market share within a network effect business, it's almost guaranteed that you're going to reach 90% market share. And when you go from 60% market share to 90% market share, that last 30% is almost all profits because you don't have to invest to get that incremental growth. And so that is very, very powerful. And what the market has missed in Amazon and Google and Netflix is that last 30% and how profitable that can become and how powerful that flywheel becomes. So my argument is, as investors, we're looking for high returns at reasonable risks. This is actually a great place to look for good returns at reasonable risks, is once you find a network effect business that has already achieved an advantage and is now gaining that last market share in an industry. So anyways, I hope that helps thinking about moats. All of the moats are great. And I'm happy to even send my presentation that I gave at the Berkshire Hathaway conference.
Okay, so Gabriel had another question. So how can we value a company's brand while not overvaluing it like Kingfisher Airlines? So I'll give my take. I guess I expect James to have a better take, but I guess you could would you value a company's brand probably relative to its competitors in order to assess the true value of the brand? What would you say?
Yeah, no, I think you're right, Saurabh. A brand is relative in that we talk about pricing power, and the pricing power that Coca-Cola can charge versus, no-name soda is that premium that they charge, so the price premium. So, but Gabriel's question is a good one, and I don't know if it's because he's watched what is it called? The Bad Boy Billionaires. It's a Netflix movie that just came out, and it's about Indian billionaires and their downfall. And one of the highlights that it highlights is Kingfisher Airlines. And Kingfisher Airlines was unfortunately an example of starting out as a low-cost airline like Southwest Airlines, and then so Kingfisher Airlines, what their moat should have been low cost. They should have been a low cost moat like Southwest Airlines. But then they wanted the brand. So this billionaire, he wanted the best brand. And so what he did is he started charging premium prices and adding all of these values to customers and trying to move up the brand scale. The problem was he didn't have the brand to do it. And so what ended up happening is he ended up, taking on huge debt, buying a lot of fancy airplanes. And then when a downturn hit, the company ended up going bankrupt. And so Kingfisher Airlines is a really great example, Gabriel, of, we need to look at price premium relative to peers, but you need to have the brand equity, the reputation, the product, the business model to back it up. And if you just if you're just building, a premium product, let's say I want to start a smartphone company and then I make the latest smartphone with all the bells and whistles, but I want to charge $1,000. There's no way I'm going to be able to charge the same price as Apple, because they've built up that brand equity over decades, and they have an ecosystem of products. And so yes, we look at price premiums to peers, what they're charging, but we also need to look at all of those soft factors of what is the brand really, what is the history, what is the ecosystem, what is the following. And you know, Kingfisher Airlines, that's a great question, is an example of, you can't just look at the price, you have to look at the full history of that brand.
Okay, so thank you, James. I'm sure that helped everyone here. It certainly helped me. So just to recap, we're looking at three. So the two questions were, how long are these profits sustainable, and how fast are the profits going to grow? So you want reliability and strength, both in one package. All right. So we're doing a learning activity, handout 2.2, I believe, should be the lesson plan. Let me see if I can put it in the chat. Should be this one, if I linked it correctly. Do you all see the link?
Yes.
Okay,
Yes.
so you can click on it, and I guess we'll keep moving. Okay, so we're looking at Apple's growth in the future. So it'll be, I believe, it'll be under, but how do we know where the company, what the value of the company is? And it'll be the second paragraph there. So, all right. So does anyone need more time to reach the point, or are they good here? Okay, they're good. All right. So let's keep moving. So, all right. So keep in mind, just to recap again, our goal is to find out how much will profits grow by, and how long will these profits last. So on the handout, it is modeled at whether Apple will grow at 5%. So this chart actually kind of shows how the power of consistent, reliable, and sustainable growth over the future. If you see from 2015 to 2055, Apple's revenues quintupled over 40 years, and that is a massive amount of money, and that can really does enhance your portfolio. So this basically shows that that the kind of the power of a sustainable long-term growth. So, and this is an example of Apple at no growth, which is one of the worst scenarios, because obviously you're just going to keep parking your money there in a stock that for almost 40 years, which doesn't provide any return. So this is one of the most undesirable scenarios. And this is an example of Apple with high growth rates. This grew by 25%. If you look at from 2015 to 2017, but it didn't grow at a sustainable rate. So it had high growth, but then certain forces collapsed its growth rate. That's referred to as margin pressure, and it was in a worse off position than at the beginning. So that was basically a scenario. The scenario of Apple is basically a case study to show what you should look for when it comes to making investment decisions. So let's look at let's do a recap again. So when making investment decisions, we have to measure how much will profits grow, and how long will they grow for. So we're going to do another case study here. So, all right, so we're going to compare two companies. Both are about roughly in the same sector. They're going to be both Walmart and Amazon. So I expect you all know what these are. Amazon represents the e-commerce side, the new guard, while Walmart represents the old guard, the brick and mortar side of the commerce business. So the difference between them two right now is that Amazon has, and both of them have roughly the same market cap. However, Amazon does make fewer profits. So the question we have to make now, the question we have to answer is, which company do you think will be more, which company is a better investment, and which company do we think will be worth more in the next decade? So these are some questions to discuss. I guess if anyone wants to share their thoughts right now, they can. Which do you think Walmart or Amazon is going to grow? Okay, so Jessica said Amazon because it's online is the way we are shifting. So yes, so that generally, so that generally drives the point that that's going to be, yeah, so that's a general trend that's in play right now, which is the shift from brick and mortar to online. That can be seen in the closure of numerous bookstores, and even Walmart themselves have realized this and they are trying to go online. They're trying to make purchases of e-commerce sites like jet.com, and they're even making those moves. So even in COVID has accelerated this. So Amazon is likely growing sales faster, especially during COVID. Amazon is likely growing profits faster, and due to the secular trends in the marketplace right now, Amazon has a far more sustainable business model in the future. Does anyone else have anything more to add beyond that?
Amazon
I
also, you could go first.
Oh, okay. Sorry. Well, I definitely agree that Amazon's gonna increase more, and the e-commerce business is doing very well. But I think we need to also look at the different other things that Amazon is doing, and their cloud web services business is a huge deal, and I think that will grow a lot in the future.
Yeah, but yeah, and you're right. And obviously, Walmart doesn't have a cloud service business. Do you think that Amazon will stay dominant over its other competitors? Like I know Oracle is getting to the business much more now. So is Google. Do you think that Amazon will be able to top its competitors with AWS?
I think AWS, Google, and Microsoft are definitely going to be the leaders of the cloud business, the cloud industry. And yeah, like you said, Amazon's going to retain its position as one of the largest.
Perfect. And yeah, that just ties into the third question, which is that it has far more sustainable profits.
Excuse me, Mr. Kana.
Yeah, sure.
Could I share something too?
Is it a link, or do you want to share your own screen?
Yeah, it's that it's about the question that you asked.
Sure. Feel free to.
Yeah. Well, I just think that since Amazon it was the first one to the game, and their market share is so large, Walmart trying to specialize in that too, it makes sense to an extent, but I also think that Amazon's brand is really well defined, and it's kind of hard to beat them at this point.
Yeah, I get your point. I mean, I guess if you look at the sales side, someone has a far better, someone is far safer trying to market their business on Amazon compared to whatever platform that Walmart may have. So that's a good point, Gabriel. So does anyone else have anything else to do? Anything else to add?
What I was going to say before is that Amazon also provides many more services than Walmart, so their profits are much more diversified. And yeah, that's another reason why their business is more sustainable than Walmart. They're also opening up many more services as time goes by. This is why regulations kind of going to start cracking down on them, because they're starting to hit monopoly level. We'll see where that goes in the future.
So do you think that Amazon may be broken up, and do you think and if so, what's the probability, and would that would you still invest in Amazon with that probability in mind?
Yeah, so that's the big problem with big tech right now. They're all opening up so many more services that they might get broken up in the future, but I don't really know much about it at the moment. I don't think they're going to get broken up anytime soon. But it could happen in the future. I think in the next 5 years is a low chance of it happening, so I would invest in them with maybe a 5-year horizon in mind. but I really don't know what would happen in the future after that.
Okay. Yeah. I mean, you can't predict
Yeah.
the political landscape. It means it's constantly changing. All right. These are really good points. Does anyone else want to make any final points before we move on? Sure.
Just to add to his point a little, I definitely think that there are competitors with Amazon, and that could definitely be a challenge in the future, especially now during coronavirus, where there's multiple online. Wow, I can't find the right word. But I definitely think there will be more competitors. I do think it's a stable company, however, but I would definitely opt for something like Alibaba or, I'm trying to think, like Lee or Xpeng, which are backed by those are Chinese companies. But I think they have good growth potential and they are similar to Amazon, but they haven't developed a brand name.
Okay. I mean, yeah, I see your point. They have far greater growth potential. Well, Amazon, I guess, has already dominated the marketplace. When you have domination, it's hard to grow from domination. But all right, so let's move on. So, okay, so that's the end of our lesson. So I thanks for listening in. So Christine, do you want James to give his talk, or do you want to go into the Kahoot? I don't know if the Kahoot is particularly working well, but
Normally, if you just cut and paste the pin, we can all go on Kahoot and do that really quickly.
so,
As long as you
okay.
show us the questions as well.
Yeah, so let me. Okay, so create kahoot.it. Let's see. It may just be technical issues on my end.
Saurabh, no worries. If you can't get it, we can just go right into James. I saw that there's another question though in the chat. It's from Mara, and she asks, isn't Amazon also branching into in-person store interaction as well? I've seen that they've announced that it would be launching a 1-hour grocery pickup of Whole Foods for Prime members in the US. Does that affect their profit growth?
Well, so yeah, I mean, I think they're good. They are going through into in-person stores, but I think that, I guess, Walmart kind of probably has mastered the in-person store thing. I think if you had the in-person store between Whole Foods or say Walmart, in terms of someone who want to go to a brick and mortar store, I think that probably Walmart would likely dominate on that front. But I guess it does add to the fact that there is definitely room for growth on within the brick and mortar area. Although the brick and mortar area, I would expect to be far more limited than other endeavors that Amazon has. James, do you want to give your take on this scenario? I think people would like to hear your input too.
Yeah, it's a great question, Mara. Amazon. A couple things to note about Amazon. Amazon's incredible. I mean, they're just an amazing business. They, when Jeff Bezos said from the beginning, we are going to focus on customers and give them more value, and the 3 words are customers, customers, customers. And every internal memo you read about Amazon, it is all about customers. They even, I don't know if you know this, when they do any board meeting or company internal company decision, they put an imaginary board member and they call that board member the customer. And they give that imaginary board member a vote, and they don't do anything unless that customer, the theoretical customer, would approve of that decision. And so Amazon has been so good because they just keep adding value to customers. And so they do things that others would be worried about. What's the impact on the quarterly profit? And Amazon just goes and they do it. And that gives them an advantage. And I would call that company culture. They have that culture of customer centricity. And that's something difficult to replicate that I think Walmart will have a very difficult time replicating. So your example of 1 hour grocery pickup with Whole Foods, you know, if it's difficult for other supermarkets to do it because it's, you know, may not make profits in the short term, Amazon will do it. And they will focus on what's the best for the customer. And in the long run, that gives them this competitive advantage. So that focus on the customer is very powerful. I would throw out a book recommendation on Amazon and on Google, Facebook, and Apple. It's called The Four. And it's written by Scott Galloway. Scott Galloway is, you can follow him. He teaches at NYU. He's really funny and really insightful. But his book, The Four, talks about, you know, the four largest tech companies. And, you know, I remember he has a part in his book, in his chapter on Amazon, and he says, Amazon is talking about doing floating warehouses that float above ground as an opportunity to expand warehousing and get them closer to customers. Does this make any economic sense relative to profits in the short term? No, it does not. Will they do it? Yes. Is it the right decision to do? Yes. Why? Because no one else in their right mind is going to do floating warehouses. And are they going to deliver by drones? Yes. Does it make sense in the short term? No. But is it the right thing to do for Amazon in the long run? Probably yes, because they can afford to do things that benefit the customer, that give them that economic moat that's so much wider than competitors. So anyways, I like Scott Galloway's take on Amazon and just their ability to do things for customers that no one else can do.
Yeah, I'm a big fan of Scott Galloway. I've heard his takes on a lot of things. He actually has a podcast that I like to listen to.
Yeah, he's awesome.
Yeah, and also Amazon, I think, is also countering SpaceX in terms of building, I think, satellite internet for the world. I think it's Amazon and Juniper, but like they have a lot of pet projects, which is really fascinating. But anyway, so I guess this concludes my part in this. And before we go, here are some resources that we can go to. If anyone wants to take a picture of it, they can do it now. My favorite is definitely Investopedia. Surfing the web on Investopedia definitely taught me a lot about. It's doing that over months has basically compounded a lot of knowledge, at least for me. But I think, and Wall Street Survivor has a very good stock simulator, which is good, which is great. But and Morningstar, if you want to look at especially mutual funds, Morningstar does great work over there as well. So, and I guess this concludes my part of the presentation. Does anyone have any questions for me before we move on to James?
Just out of curiosity, right now, what stocks are you interested in? Because you seem to have a good scope on the general ideas of the market.
Can you repeat that?
I'm sorry, I talk at like 2 times speed.
Okay.
What stocks are you interested in at the moment in our current market?
I'm interested to hear the answer too. Saurabh is a very smart investor, so I'm taking notes too.
Yeah. So I've definitely been interested, especially in things that are going to be affected by the changes that are come in COVID that are going to come because of COVID. So I was thinking especially a lot of consulting firms, since I guess post COVID there's going to be, I guess, a grand shift out of places like China. So, and to move to at least diversify their manufacturing, and a lot of consulting firms are going to be, and banks at least, and these advisory places are going to be very, very crucial to move their manufacturing out. Since I guess a lot of the groundwork, a lot of the research is going to be done by these consulting places. So that, and a lot of, I guess, these trends that COVID has accelerated or started, I think that's going to be the big catalyst that people should jump on. So does that answer your question?
I definitely think it does. I kind of covered the niches that you're looking at. So
I hope James likes the idea at least a little bit. But yeah. So I guess this goes. So thank you for listening to the presentation. I'll I guess I'll put it to James. Fun fact, actually, James and I grew up in the same county, and our high schools have played tennis against each other. So, but beyond that,
It's my
James?
claim to fame is I grew up in the same town as Sarab did.
Yeah. But I appreciate James for coming. I guess you can. I'll stop sharing, and James, you can take it away.
All right, great.
I just wanted
Sarab,
to
incredible
say
presentation.
Sarab.
And I'll go for it, Christine.
I just wanted to say thanks to Sarab for being our student advisory board instructor today. I think he did a phenomenal job. So great job, Sarab. I love that our student advisory board has stepped up to teach our YIS Global Online Club lessons. Without further ado, I'm going to give it over to James. James is going to be talking about the stock market outlook during COVID. So super excited for that.
All right, well, welcome everyone. It's great to see many of you on the Zoom call, and great to hear Sarab's lesson. He's an incredible teacher, and greetings to all of you on YouTube. This is a pleasure to share some thoughts. So I'll go through a couple of slides on my outlook of the markets, share what my compliance department will allow me to share, and we'll go through the markets, and then I want to leave some time for questions at the end. I've already gotten a couple questions which we shall cover. So first quote, one of my favorites: "Without a saving faith in the future, no one would ever invest at all. To be an investor, you must be a believer in a better tomorrow." So as investors, which we all are, we're believers in a better tomorrow, even despite the COVID year that we're going through and the uncertain environment. Remember that we're investors and we're believers in a better tomorrow. Okay, so I thought this was a nice comic to kick it off. We have one investor saying, "My stocks are doing great. What else do I need to know?" And then we have someone else reading their paper and saying, bankruptcies and national debt and all of the problems that are going on in the economy. And so the question is, do stock market investors have blinders on right now, and that they think, or are they right that stock markets are at all-time highs and unemployment is also reaching all-time highs? This seems to be a big dichotomy. So what is going on here? And we'll cover some of that. So this is one of the reasons, and we've touched upon it in our lesson, is that this is year-to-date performance, and the reality is the S&P 500 is up, but all of the big tech companies, or the majority of them, are up substantially. So Amazon is the biggest performer year to date. It's up nearly 90%. But so are Apple and Netflix and Facebook and Google are just having phenomenal years. So what does that mean? It means that the majority of the stock market is either flat or down year to date, and especially sectors that are hit harder like energy or like consumer discretionary like cinemas are down. But yet you have these big tech companies, which are pushing that overall average up, because the S&P 500 and the Dow is only an average of performance of those large companies. So where are we in terms of valuation? Let's see if it's cut off it on the side. So I think it's always helpful to look at long-term valuations to get a sense of where we are in terms of the cycle. And here we look at the PE ratio of the market. And we can see that the US PE ratios are above average. So they are at a pretty high level at the moment. This is a trailing PE. So this is the last 12 months of earnings, which have been, so you could say this is a COVID year of earnings. And so maybe we need to normalize the earnings. So that would put the multiple too high for the US. But even still, even taking that into account, I think it's fair to say that valuations are on the higher end, and then developed markets is Europe, and then emerging markets. And the triangle is actually the forward PE. So that probably gives you, that's the next 12 months. So that probably takes out the COVID effect. And even there, we're at high valuations, except in emerging markets, which are below their long-term average. So as an emerging market investor, I would argue that there's still value to be had, especially in international and emerging markets. And US markets are looking relatively expensive at the moment. Okay, next slide. You've probably read articles about how millennials are taking over the market, and I view this as a great thing. It's many of you, and it's our millennial audience that are signing up on Robinhood as a proxy for sort of millennial account growth. And you can see that has dramatically taken off. Let's see, I'll use the laser pointer. It's dramatically taken off and this year, and that has had some correlation to overall market levels in terms of driving up stock prices. So I applaud the impact of millennials getting into the market. At the same time, let's be careful. I don't want millennials to get burned and have, you know, end up losing money, and so that they get burned and they don't want anything to do with the stock market going forward. So let's make sure that we're staying rational in terms of the prices we're paying and the businesses that we're investing in. And then the last, you guys know I love long-term stock market charts, but this is just to put it in overall perspective, is that in the long run, the stock market goes up by about 9% per year. The majority of that is because corporate profits go up by about that amount, plus you get about 3% in dividends. Corporate profits go up by about 6% a year, and that drives, long-term growth in the stock market. And so where are we right now? We're slightly above the long-term trend. In March, when we saw the sell-off there, we went below long-term trend, and that was, looking back, our buying opportunity, which was a good buying opportunity. But in the long run, the message here is stay in the market, stay invested, and in the long run, the stock market will go up over time. Okay, so this is my main slide. Wanted to give you guys some value, some tips in navigating this market this year. So what are some of my top ideas? I mean, I would say stay in sectors that have structural growth and pay reasonable prices. So some examples of sectors with structural growth are the shift from offline to online, which Saurabh talked about, companies like Google, Amazon, Facebook, Shopify, but so many others. Trends are being accelerated under COVID, and these companies are taking share away from their offline peers. And when you look at the whole pie of things, e-commerce percent of sales in the US is 14%. Could that go to 25%? Absolutely. And so that gives a good track record there. Google advertising share of global advertising is about 4%. Could that go to 10%? Absolutely. And so you look at these structural shifts offline to online. Another is healthcare. Pharmaceuticals is kind of is the big headline, but I would say focus on the suppliers of healthcare. You find some great businesses there. One of the first anecdotes I heard in investing is, who made the most money during the California gold rush? It was those who sold the picks and the shovels. It wasn't necessarily the people going after the gold. It was the sellers of the picks and the shovels that made the most money. And so you can apply this to pharmaceuticals, you can apply this to the oil industry. Maybe don't own the guy going for the gold, own the guy that's supplying to all of the guys that are going for the gold. We made our most money. The most money we made this year in a stock was we owned a company that went up 300%. And who was this company? This was a Malaysian company that produces gloves, rubber gloves for the healthcare industry. And what happened under this scenario is there's a shortage, a massive shortage of healthcare gloves. And so they increased their capacity, but there's a shortage globally of gloves. And so then they raised their prices significantly along with the rest of the sector. And profits have gone up, stock prices shot up, it's skyrocketed. And the question would be, is like we were talking about before, is this a up and down? But we actually see this as a sustainable trend where people are more aware of germs and the value of cleanliness, and that doctors, especially in developing countries, are more apt to use gloves going forward. So we just see this as a structural long-term trend. Consumer shifts like health and stay at home, these are powerful business models to focus on. So the second thing I would say is look for visibility, consistency, and pricing power. So don't get sucked into a stock that has hype or a trend of the day. Look for visibility, consistency, and pricing power in those businesses. The next point I would make is don't worry about noise. There's a lot of noise about politics and what happens if Biden's elected, what happens if the Democrats sweep. But remember that you're in this for the next 50 years. And so politics will come and go, parties will come and go. You want sort of long-term visibility in your investments. The next point I would say is maybe a little counterintuitive and maybe something you don't want to hear, but I would expect lower returns and I would be happy with that. The reality is valuations look relatively high at this point. And the fact is that interest rates are low. And so if you put money in a bank, you're going to get next to nothing. And interest rates, you look at the 10-year yield is below 2%. It's next to nothing. And so if I'm getting 2% risk-free, should I expect to get 15% in the stock market? I would say no over the next 5 years. I would say that's a stretch. So I would set your sights lower and be okay for sort of 8 to 10% returns. That's what history is telling us, that at this valuation level, at this point in the cycle, we should probably expect lower returns going forward. This doesn't mean pull your money out of the stock market, but it does mean when we're doing our math, I wouldn't just look for a high growth, high return business and not look at a stable, solid return business. I would be wary of taking too much risk at this point in the cycle. And so, I get the question, how much is too much? What is expensive? What is a reasonable price? I give you guys a tip here. Price to sales above 15 times is a lot. And so there are sort of tech businesses and COVID businesses that are selling above 15 times. And I would just be very hesitant of paying more than 15 times revenues or sales. And then on a PE basis, which we talk about a lot, earnings can come and go. And under COVID, a lot of companies have no earnings, but then normalized earnings are going to be higher. I would say look ahead, 3 years, look to 2022 earnings, look what normalized earnings should be for this business once they come out of COVID. And if you're paying over 50 times earnings, that is a lot. And so what I want to do for you is to make sure that you're investing in good companies and not getting caught in a 2001 tech bubble of losing 90% of your money. And so those rule of thumbs will probably keep you in the good returns businesses, great businesses with good returns, and away from sort of a bubble exploding on you. And then the last thing I would say is be greedy when others are fearful, and be fearful when others are greedy. And so when you see others being fearful, that can be your opportunity. And there's plenty of spaces where people are fearful today. And when people are very greedy, very hyped, and there's plenty of those as well today, be a little cautious, be a little careful. So I know we're at time, and I want to give some time to Q&A. So with that, I'll turn it over to you and say good luck investing. I believe in you guys. You guys are amazing. And yeah, any questions that you'll have.
Excellent. Thanks so much, James. I actually have Pranav. Pranav has a question for you today.
Yeah, so hi, Mr. Fletcher.
Hi, Pranav.
So my question today is about brick and mortar retail store bankruptcies that have been going on this year. So as we all know, many big name retailers have been shutting down this year. And the direct cause of this, at least this is what people have been saying, is the pandemic and how people aren't going shopping nearly as much anymore. And this is true, but how I see it is that this was going to happen eventually anyways because of all the technological advances we've been seeing and the rise of e-commerce. And in 10 to 15 years, there isn't even going to be any like brick and mortar retailers left. So my question is that do you think that some big retailers are still a good long-term investment, or are they all going to go down eventually?
Yeah, it's a great question. It's a tough time to be a brick and mortar retailer over the next 5 years, 5 to 10 years, let's say. And so that should be our first assumption. It'll be a tough time. My first advice to you was stick to sectors with structural growth at reasonable prices. Brick and mortar retailer is not a sector with structural growth. You know, so that's where I'd start. I think your point is a good one, that COVID probably accelerated the trend that was going to happen anyways. That being said, I think there is a place. I don't think, my personal view, I don't think e-commerce is going to be 100% of retail sales in 10 years. So it's at 14% today. Under COVID, it's probably I think it's shot up to 20% of total sales, or 25%. It probably comes down once stores open again. But I don't think it ever goes to 100%. I think it probably goes to 40, 50%. That'll be very, very painful for a lot of brick and mortar retailers when it continues to shut down stores. But I think there is place for some stores that require that in-person feel. And so niche retailers, especially, fashion retailers or retailers where I think an omni-channel is a good place to be, where you go look at it, there's a showroom, and maybe you buy it online, maybe there's other distribution formats 20 years in the future. But I think there always will be that social aspect and that feel aspect to retail. So my personal view is I don't think it goes away completely. I think there is still good niche retailers that are doing well, but then the big box retailers will likely continue to struggle.
Yeah, because there's always going to be that social interaction aspect to shopping and going out with your friends to the mall or whatever.
I think so. But we'll see. So I would be cautious for sure. But yeah, I think there probably is a place for them in the long run.
Okay, thank you.
Excellent, thank you. I have Eliana who has a question.
I was just a little bit curious about, in terms of options trading, so puts and calls during the pandemic, what your thoughts are on that. Because the more I look at it, I'm like, oh my gosh, why isn't everyone doing this? Because I'm like, this is like golden, like practically no risk. I'm just wondering what you think about that.
Yeah, so options trading have a couple of advantages. One, you kind of set your downside limit price implicitly when you buy the option. So you're paying a small amount, and then if it goes below the price, you just lose that small amount. And if it keeps going up, then that option is more valuable. And the other advantage that options have is they magnify your gains. So it's a leveraged gain. And there's different option strategies that you can use. I think there's benefit in this environment, obviously, of volatility, and with the markets going up, options look really good right now. because it controls your volatility and it gives you amplified upside to gains. So options look really good right now. When options are maybe not as necessary, are when there's not as much volatility, when the market is sort of in a steady climb, or when the market's going down, and then you can lose a lot more money on options. So I would say there is a place to it. What I personally like doing is, I'll invest, I'll not through options just by buying the equities, but I'll invest with limits. So you put a limit price on the bottom with a stop limit, and you put an entry price where you're going to buy. And that sort of creates the discipline of options, but without the risk of the leverage that options will have. So that's how I control that risk. But good question.
Thank you. I think that really cleared it up for me.
Excellent. Thank you so much. I have Saurabh, who is going to ask a question.
Yeah. Am I allowed to ask two
Great.
questions by any chance? I just formulated a question, another one. Am I allowed to ask the second one, Christine, or?
You know what? Sure. Yeah, we're going to have.
I'm fine. I'm fine on time if you guys are fine on time.
Okay, so I was going to ask, my first question is going to be about the amount of corporate debt. I think the corporate debt is one of the highest, or I think the highest as a percent of GDP in the US. So do you think that the pressures due to this COVID crisis, do you think that'll cause any issues in terms of at least downgrading this large amount of corporate debt possibly to junk? Or do you think that the Fed or the government will step in to prevent the possible crisis from happening?
Yep, good question. What's your second question?
Oh, my second question was about there's just recent news that apparently certain central banks are creating projects to create their own digital currencies. I was thinking that if the area of digital currencies, Bitcoin, etc., is that a possible area of interest for investing, and how would you go about entering that space?
Oh yeah, great question, Saurabh. Okay, first one on corporate debt. Yes, so corporate debt levels are high across the world, not just US. They're high in Europe, they're high in China. It is a worry that we worry about. But at the same time, we see a lot of companies like airlines being bailed out and being subsidized through COVID. And so how do we play that? My personal way, how we're investing it in our fund is we're staying away from the play of this is a highly leveraged company, but we're going to wait for the government to bail it out. I know investors that are playing that and making money because the government seems very apt to say, as Paulson said, whatever it takes, and they'll bail it out, and those companies can sort of skyrocket over the short term. Personally, I'm wary of debt at the moment. So we have a very safe portfolio in terms of balance sheets. Actually, a third of our companies are net cash and at the moment, and we have very low debt levels across our portfolio. So I'm wary. I don't want to rely on government bailouts for debt, especially, and it's the big market risk that everyone talks about, that no one knows when it will happen. But if inflation comes back and interest rates start rising, then all of this debt will have to pay much higher rates, and that can wipe out companies quick. In the moment, inflation's very low, interest rates are very low, but who knows? And that is a risk that could happen over the next 3 years. There's a lot of money going into the system, and if it does, I don't want our portfolio to be in trouble of rising interest rates. So I'm personally staying away from leverage companies at the moment. Second question on cryptocurrencies and government's involvement on cryptocurrencies. Yes, so as you know, I'm here in Hong Kong, and the big talk recently is that China is developing a cryptocurrency, and they are starting to sponsor it within state-owned banks. If that becomes mainstream, so you currently have a system where the global reserve is the US dollar. So all commodities are priced in US dollars. and the global reserves of central banks around the world is in dollars. And if there was a crack in that assumption, it would be cryptocurrencies, if cryptocurrencies can take off. And I think that's why China is investing some into cryptocurrencies, in their own cryptocurrency. It wouldn't be Bitcoin, but because if that took off, they could get away from the dollar reserve, and that would be very powerful for China. So it's not necessarily impacting our portfolio, our stock portfolio. So, Bitcoin for me is very speculative, given that the demand supply is not driven by typical demand supply that I'm used to as sort of a fundamental investor. It's more sort of speculation of demand supply. But the trends of blockchain and cryptocurrencies, especially if countries adopt them, could be, we'll see. It's something to monitor, and that would obviously be very negative for the US dollar if cryptocurrencies were able to gain ground within government acceptance. As of now, the regulation is so tough against cryptocurrencies that it's tough for them to become mainstream.
Excellent, thanks for that. I have Gabriel who has a question for you.
Hey, Gabriel.
Hey, let me try to find it because like there's so many people that type that I can't like find it anymore. Okay, I found it. Sorry.
Yeah, you guys have a lot of good chat questions. Appreciate all of the chat.
Okay, so my question was, how do you believe the automotive industry is going to respond to like COVID? Because I've noticed in the stock reports that a lot of stocks are like not being affected as badly, but like some stocks like Tesla are really volatile. But at the same time, like not that many people are driving. So how do you think that companies will be affected?
Yeah, auto industry is an interesting one, and I knew Tesla was going to come up today because Tesla's just been such a home run this year, and yeah, such a beneficiary of COVID and this environment that we're in. It's similar to the discussion we had about e-commerce. So e-commerce is at 14% today. Where is it going to be in the long run? Maybe 40, 50%. And so that is a huge runway of growth ahead for e-commerce. And obviously Amazon is benefiting from it. Shopify is benefiting from it. And then, similar thing for EVs. EVs are, 2% of sales today. And where will they go over the next 10 to 20 years? They can go to 20%, 40%, 100%. And so that's sort of your assumption of how big they'll get, but they will get much bigger. And so if you have a Ford or a Chrysler or a VW, and you're trying to forecast their profits and their cash flows 10 years from now, and then you're looking at their models and they're behind on their EVs, you at least need to model it in and sort of take account of how much lower those profits could be in the future. And so that's why those stocks are trading very cheap at like 7 times PE ratios, because the market is worried that their sales that are 100 today could be 50 in the next 5 or 10 years. And then I think the second part of your question was, what is the impact on overall driving industry under COVID? One of the tricks is to look at companies that are, or look at countries that are into COVID and then come out of COVID to gain some insights. And China is the one to watch there, because they went in, they had their COVID hit, and then they're coming out of it, and people aren't even wearing masks in China anymore because the cases are zero. And so what we see in China is that people come back to cars in a big way after COVID, and even during COVID, because people are worried about taking the subway and they're worried about taking public transportation. And so a lot more people are actually buying cars. And so I would say the impact, at least in the medium term on the auto industry, is positive, is that more people are more aware of not taking public transport. And then you combine that with EVs, and you see why Tesla's done so well this year.
Thank you, Mr. Fletcher. I know, yeah, talking about China, I noticed really recently that like the day that Tesla announced that they were going to be like starting factory production in China, the stock increased a lot. That was the day that it increased the most for my portfolio. It was really cool.
Ah, good. Well, congrats for you for owning Tesla. You're a rich man if you put a good amount of money into Tesla. Absolutely. Local production in China for Tesla is a game changer. And what they're talking about, what they talked about during their battery day is using that China production to then export to Southeast Asia and other Asian countries. And so having sort of low cost production in China and be able to export it to other Asian countries is very powerful. I'll make a joke. We live in Hong Kong, and Hong Kong is a wealthy country, but my wife made a joke the other day. She said, I don't want to get a Tesla. They're too mainstream. So she called Tesla a mainstream car. Why? Because everyone has a Tesla in Hong Kong. I mean, it's like a third of cars on the road are Teslas, and they're mainstream in Hong Kong. And so Asians love Teslas. There's no doubt in my mind that Tesla will have a huge market in China. And so that production facility there is a game changer. And I think as Teslas become more affordable over time, they will continue to sell more. I think the stock is expensive. And so I would be personally hesitant at Tesla stock at this price. You need to do the 10-year numbers and factor in sort of your expectations, not just by sort of the stock price trend. But it's a powerful business that they have for sure.
Mr. Fletcher, sorry, Miss Tobin. But since we keep talking about like EVs and it like ties into like niche markets, do you think that like niche markets like luxury and EVs and those sorts of markets are gonna be less affected by COVID since it's more like they've been established for so long?
Yes. And that's actually a good point to be aware of, is that luxury has done well through COVID. New trends have done well through COVID. So you need to think 2 years out, when we have a vaccine and when COVID is sort of diminished, those luxury sectors probably won't be as in demand from investors, the scarcity value of a business that's able to hold up during COVID, as maybe some of the recovery sectors. So be aware of that in sort of the market cycles, is that luxury's done very well. Niche sectors have done very well during COVID, but those may cool off during sort of normalization. So that's a good point, and something to be aware of.
Thank you.
Yep.
Thank you. Jack Swisher, you had a question for James.
Yeah, so it's crazy, but you basically answered my entire question in the discussion we just had.
Let's hear it.
Yeah, so I was gonna ask about Tesla in China and your thoughts and how it's gonna grow in China and stuff like that. And you said, which I'm very happy about because I'm also an investor in Tesla, that they're gonna be really popular, and they already are to some extent. But I've heard that some people fear that like because China might not want a intelligent network of cars all throughout China accessing internet data and data on people, that China is going to restrict Tesla and instead prop up other EV companies like NIO and other competitors. So
Yeah, that's a great point to add to it, is that China's very sensitive of data, and the automated driving uses a lot of data. So what will Tesla's impact be there? You mentioned NIO. NIO is the Tesla version of China. I don't think NIO cars look nearly as good as Tesla. And I don't think they have the same brand, as I talk to Chinese citizens, as Tesla does. But NIO's stock has done phenomenal as well, and they're nowhere near profitable. It's a good point. It's a good point. I would, you know, investing in China, as you know, this is what I do for a living. You need to, the adage in the US is don't fight the Fed. In China, don't fight information, and the governments need to control that information. So, for me, it was kind of a no-brainer to invest in Alibaba or Tencent or the leading internet companies that are on good terms with regulators, and there's no way that a Western company is going to be able to come in, because that information and that relationship is so important to have with the Chinese regulators. I don't think, but at the same time, on the other side, you have Chinese companies, you have multinational companies with premium brands. Luxury sells incredibly well in China from France or US. Chinese value brands, and they value Western brands. And so Tesla is kind of right in between, right? It's the Western brand, but it does have some information that China's going to favor their local champions above Western companies. But I would say overall Tesla should be fine. If you look at other automakers in China, China has a good track record of doing a JV with Hyundai or Toyota, having a Chinese partner be part of that JV, and then those companies can sell and do well in China and even grow above the local market players. So as long as Tesla will probably need to have a strong Chinese partner at some point that has a good relationship with the government, and as long as they can navigate that okay, they'll probably be okay. But it's a good point. It's a good point. And maybe in your estimates of Tesla China sales, maybe you put a discount and put a probability that may be zero. And does that change your investment decision?
Great, thanks. James, do you have time for one last question from Luke?
Yeah, sure.
Perfect. Go ahead, Luke.
Hi, Mr. Fletcher. I was
Hi, Luke.
wondering if you made any investments where the thesis directly or indirectly involved climate change or ESG factors, and generally as an emerging markets manager, how are ESG factors sort of considered?
Yes, great question, Luke. And so I work for, I manage a $1 billion portfolio for the APG Asset Management, which is the largest pension fund in Europe, which is the pension fund of the Netherlands. Netherlands, as you know, are extremely forward-looking on ESG and sustainability and climate change. And I would say, as a result, we integrate ESG factors into our process as much, if not more, than any other sort of investment fund out there. So it's highly embedded into our process. Yeah, we could probably talk hours about how we embed it, but we do a 50-point scorecard of governance, social factors, and environmental factors. It takes us about 10 hours per company to go through the ESG scorecards and look at the board backgrounds, look at the people backgrounds, look at the social factors, the employee pay, the compensation, the employee reviews, and then the environmental factors, their metrics of carbon, their metrics of waste management, and their disclosures, their mission, their centricity. I mean, all of this takes us a long time that we go through for every company we invest in. What I would say, as sort of to answer your question, one of the points of ESG is UN sustainability companies called SDIs. Sustainable Development Initiatives. And these are companies that fit into the UN development goals. And these are healthcare companies or companies that alleviate poverty or reduce waste around the world. Our portfolio currently has 25% of our portfolio in SDI companies. And those companies this year have been our best performers by far. And so actually we've added a lot of alpha. It's helped us beat the market by investing in these SDI companies. So companies that, Riverstone we talked about in Malaysia that makes rubber gloves, that's related to healthcare. Our healthcare companies have done phenomenally. Our waste management companies, so we own a couple waste management companies in Korea and Taiwan, have done phenomenally. So those trends are long-term secular trends that you can do well. The caveat is you don't want to invest in a company just because they're an SDI. So just because they are a renewables company, that can't be your only reason to invest. If they're not profitable, if they're not growing, if they don't have a good management team, then this won't be a good investment. And a lot of investors got burned in solar, for example. They went in big into solar. Solar is going to grow, which it has, but the solar companies ended up being terrible investments. And so you need to be careful about separating the long-term trend versus the company. But that being said, when you can find great companies in those buckets, in those SDI buckets, you can make a lot of money because it's a long-term secular trend and you can own the right businesses in those trends. So great question, Luke, and it's something close to my heart there.
Thanks so much. Great answer. Wow.
All right, well, we might have some last minute questions from anyone who still had a question and didn't message me. So if you still have a question for James before he leaves, now's the time. Anyone?
I appreciate all of these questions. You guys are on the ball. Holy cow.
I had a question about merger and acquisition deal flow. So as we know, before COVID hit us, M&A deal flow was at an all-time high, or it was really high. But now this year it's been down because of the pandemic, and corporate activity hasn't really been as high as it was before. So how long do you think it'll take for it to go back to normal and the heights it was at before?
Yeah, good question. I think in this environment that we've been in for the past 5 years, and which we will probably be in for the next couple of years, which is interest rates are very low, so capital is very cheap. Companies are for the most part generating cash and are remaining profitable. And then growth is very low. So growth is very scarce in the market because there's very little global growth. As we stay in this environment, that is the perfect recipe for deal flow, because a company has cash, they're not growing, but investors want them to grow, and they can get almost free capital from banks. So what do? They go buy growth, and you go buy companies to get growth. And so I would expect that if we stay in low interest rates, with access to capital, low growth, and still profitable cash generative businesses, that we will continue to see M&A deal flow. And we've seen it. I mean, venture capital industry, private equity industry is starting to pick up if you look in these past couple months. And so, there's a number of VC big deals that are getting done. There's flows, and I would anticipate that there will still be a good amount of deal flow as long as capital's free and investors want growth, but there's no growth to be had. Then you'll start buying growth.
There's a lot of arbitrage opportunities in today's economic scene.
Yeah.
Excellent. Thanks so much, James. Thank you for your time today. I really appreciate you taking out the time of your morning to be here with us. We also had some students here from Malaysia and Hong Kong today. So it was great that you guys got up early and were able to join Yes, and I want to thank Leon. Leon is one of our YIS ambassadors. He's been answering questions in the chat and posting links for students to do some more research. So thank you so
Thanks,
much,
Leon.
Leon. All right, you guys. Well, this concludes our discussion session for today. Tune in next week, same time, same place, on our Zoom video, and I'll see you guys next week.
Bye, guys. Great
Bye.
questions.
Thank you.
Thank you.
You're amazing.
Bye.
You.
Thanks so much. Bye bye.
Thank you.
Bye.